Hi, I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast.
Hello, as you can probably tell, we're in a little different setting today. Not our normal studio with the American flag in the background and no birds chirping and wind. We're on vacation here in Florida, um, but there's a lot of stuff going on in the world, and to just put out normal podcasts when there's potentially escalating war footing across the world, I don't think makes a lot of sense. So we'll put out a regular podcast that came out yesterday, but I also wanted to just give you some data and try to put things in perspective for at least for what I do for you. I don't get into the politics and the opinions of what's going on, but I do want to give you some sort of information as to how this might impact or not impact your portfolios. Okay, so and again, you're going to hear some airplanes, you're going to hear some birds, and we really aren't going to know how this is going to play out with portfolios, obviously, for a while. But for some perspective, and I want to lead with the data where I got most of this from is it was an article, and they called it Toolkit: Wars, Geopolitical Shocks in the Stock Market, published on January 5th, 2026. It comes from First Trust Portfolios and Ken French Data Library, the CRISP database, and Bloomberg. The CRISP database is where we get most of our information when we are building portfolios. Chicago Research for Security Prices. It's in my opinion, University of Chicago, Ken French, Eugene Fama. It's what all the Nobel Prize-winning research is built on. So that's where this is coming from as well. So for some context in terms of war, and now I have 24 instances of war dating back to World War II. We're not going to cover them all because I want to give you one-day reactions to big events, and then how did it end up and how long did it take to get positive again. I will start with the Pearl Harbor attack. So that was obviously December 7th, 1941. The one-day return there was negative 4%. I'm rounding these numbers, 4.15. The one-year return was actually positive, almost 4%. And this is the S&P 500 is what we're talking about. However, the max drawdown, so at one point before that year was over, it was down 20%, and it took 300 days to recover. So relatively quick snap if you think about that event, right? I mean, the bombing of Pearl Harbor. We're going to skip over Korea. We're going to go to the Cuban Missile Crisis because I talk about the missile crisis a lot. That was primarily middle October of 1962. One-day return heading into that weekend was basically flat. The one-year return was up 30%, but at one point the U.S. market was down 7%. It took 8 days to get down 7%. It took only 17 days to recover. So a whipsaw effect, right? And this is kind of typical when you talk about big military conflicts that seemingly come out of nowhere. Not that the missile crisis came out of nowhere. It really didn't. The Six-Day War, this is 1967, Israel, Egypt, etc. One-day returns, U.S. stock market down almost 2%. One-year return was up 19%. Literally took 1 day to recover. That was quick. That happened, again, whipsaw effect. You're going to see this a lot. Skipping over Vietnam for right now, let's talk about Iraq when they invaded Kuwait. This is 1990. This is like my first memory of real war myself personally. Basically, the market was down about 1%. Within a year, it was up almost 14%. Took 69 days to recover. 9/11, we've covered that before, so I'm going to skip that one. Let's go into more recent stuff. So Russia invades Ukraine. That was February 24th of 2022. It seems like yesterday. Actually, the markets were up almost 2% when that event occurred. One-year return, we were actually down 5%. So that was that 2022, kind of coming out of COVID. There was other stuff going on. I don't know that really it was the military conflict that was the issue. At one point, we were down almost 7%, but it took 14 days, 2 weeks to recover. And then the most recent one, aside from the Iranian situation here, hopefully that's not more military conflict going on. When the terror attacks happened in Israel, Hamas-Israeli war, that was October 7th, 2023. Most of us remember that. I mean, it seems like a month ago, although it's almost 2.5 years ago now. Markets were flat. The one-year return was up almost 35%, and then we don't have data in terms of recoveries and stuff because it was so recent. My point in this is this. I don't know what markets are going to do today. We're recording this on Monday. I think it's March 2nd. So Monday, March 2nd. Obviously, the bombing of Iran happened over the weekend, actually happened Friday night. So we don't know. What would be typical in history is we would have kind of a quick reaction in the market, but it would whipsaw. It wouldn't be surprising, again, a midterm election year, because we did this as well. It wouldn't be surprising that markets went negative at some point. A lot of fear selling out there in terms of the media and a lot of political commentary on both sides. I'm just going to tell you that history is on our side, and there's really no reason to worry about the market reactions to this. Politics and military and all that kind of stuff aside, the markets are going to be resilient. They always are. World War I, World War II, Cuban Missile Crisis, many Middle East conflicts, recent and is back, in the 60s. Really, the markets always kind of respond the same way. Now, I have no idea what's going to happen in the future. We don't predict the future here, but history puts us on sound footing. So if you're worried at all, give me a call, shoot us an email, or forward this to people, maybe in your friends and family who might be worried about it. This is good data to just remind people that we've been here before. Wars will never not be a situation, so we're always going to have to kind of price it into our portfolios and how we construct them, which we do. And that really is the point of any of your short-term fixed income that we hold. Those bonds are not for yield, they're not for return, they're for stability. So obviously we didn't predict a conflict with Iran, we don't predict anything here, but we do have foresight enough to build your portfolios in a way that when shocks to the system occur, they can absorb those things and help you move forward over time. And so that's our information as best we have it now. If there's any major updates, we'll put it out there. But, I would expect just kind of hold the line. Don't worry too much. If you do, just give us a call.
Joseph DeLisi is a registered representative and financial advisor of Park Avenue Securities, LLC, OSJ, 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-648-4600. Securities products and advisory services offered through past member FINRA SIPC, financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PASS is the wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PASS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. CA Insurance License Number 0D34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only once coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue or advise with regard to mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market, interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 8799413.1 expired 28-3.